unchanged after its March meeting, but making some substantial and some not substantial changes to its forecast. First, the ones that didn't change. The median funds rate for the forecast sees no hikes through 2023. That's the median. There were some changes inside. I'll get to those in a second. It sees inflation at or above 2% this year through 2023, including 2.4% this year for the PCE indicator. It lowered the employment rate forecast to 4.5% for this year, going to 3.5% by 2023, and it boosted its GDP forecast. This is the average or median forecast for all Fed officials, boosting it to 6.5% from 4.2% for this year. Talking about those famous dots, where are the Fed officials when it comes to the outlook for rates? 4 officials now see 2022 rate hikes. That's up from 1 in the prior, that is the December projection. 7 officials see 2023 rate hikes. That's up from 5. But still, there's no change in the median because only a small number continue to call for those rates. Let's get to the statement now. The Fed saying, or a new change in the statement, that economic and employment indicators have turned up recently, though sectors affected by the pandemic have remained weak. Fed continues to see inflation running below 2%. That is its 2% target. And using some boilerplate language from prior statements, is committed to using its full range of tools. The path of the economy depends on the course of the virus, and policy will remain accommodative until the Federal Reserve achieves its goals. Asset purchases will continue, as it said in the past, until substantial further progress has been made. The decision was unanimous. Tyler.
All right, let's follow up with a couple of questions. On inflation, they see for the full year, even though it's running below 2% now for the full year of this year, 2.4% inflation, 4.5% unemployment this year, dipping to 3.5% by 2023. Right. How close are they really, and what is the implication for policy? How close are they really to that dual mandate imperative that they want to hit, which is inflation of 2% or maybe a little above, and full unemployment, which is, I don't know what it is, 3.5%, 4%?
Well, I have to amend your question, if you will, Tyler, with all due respect.
Sure.
Remember, the goal is to aim for inflation above 2%. So
correct.
It hits it this year. So maybe it hits that inflation goal, though it does go back down, pardon me, to 2% in the next 2022 and 23. And it gets to 3.5% unemployment. Now, I have to take a guess or a stab and say that's their goal, right? Getting back to the prior low unemployment rate. So that doesn't happen until 2023. So the dual mandate, if you take these literally and you make some assumptions about where their goals are numerically, they don't hit the dual mandate till 2023, and they don't see themselves really even raising rates then. The median forecast for the funds rate in 2023 remains 0.1%. Their longer run longer run goal or potential is 2.5% for the funds rate.
So let me ask you a quick follow-up here. You said that 4 of the members expect rate hikes, the first rate hike to be in 2022, next year, and 7 are predicting it for 2023. How big a difference is that from just the last meeting? I think you said there was only 1 who was going to go on the record as saying rate hikes were coming in 2023 or 2022. I've forgotten.
2022. I've got to look at 2 separate documents here, Tyler, if you don't mind, and
sure.
I will tell you exactly what the story is. So there was 1 prediction for a rate hike in 2022. That's now 4.
That's
so
now 4.
3 became brought it forward, and there were 5 forecasts for 2023 rate hikes. These are back in December, obviously the last projections, and now there's 7. So obviously
how big a change is that? Put that into a context. Is that more than people expected, roughly what you might have expected, and how does it fit in historically?
I think it's in line. I think it's in line. Look, Tyler, during the pandemic and in the middle of the pandemic, we had nothing but doves on the FOMC panel. I think now, David Kelly was talking before about, is it 9-9? I think now what we're seeing here is a little bit of kind of, separation back to maybe some traditional stances that some of these FOMC members took, which is you're going to have some members who are going to be more hawkish. They're going to want to move a little faster. Some are going to be a little more dovish. I think when you have situations like that, well, you ask the most important question, where's the chairman? And I think the chairman right now is very dovish when it comes to wanting to keep interest rates down, keep policy in place until they achieve their dual mandate. It's significant. There's a discussion obviously going on. There are differences of opinion, but when the median doesn't change, it tells you that the full weight of the board remains behind this dovish policy.
All right, Steve, thanks very much.
Shepard Smith here. Thanks for watching CNBC on YouTube.